Hello everyone. I am doing this mortgage tutorial for the people who are new in the market to purchase the house, and they are looking to get pre-qualified to see how much of the loan they are qualified for and what the banks and other lending institutions look in them in order to qualify them for the loan. So three C's, that's what you're looking in the screen. And these are three C's the lending institutions or banks or all the credit industry are based on: credit, capacity, and collateral. I'm going to just give you just a little bit ideas on this one. We're going to move forward to calculations. That's where the people get confused how much they qualify for. So I'll just give you a little summary on this. So credit is your credit score. Of course, they see your scores and also some other things in your credit score, credit report, like foreclosures, bankruptcies, any liens or judgment in the past, any mortgage delinquencies. If you have, let's say, 30 days late in last 24 months, it's kind of a no-go. But if you are newer, first-time home buyer, you're fine with that. You don't have anything in the record, but they probably ask for a rental history, which is easy to get. Any other credit delinquencies, 30 days, 60 days late on the credit cards, it can be explained, but they accept that. Oh yeah, credit account age, that's the main thing. People sometimes they want to clean up the credit before they start doing a mortgage shopping. So what they do is they have those 10-year or 12, 15-year-old cards open, which they hardly use, and $200, $300 limit, especially those gas station cards, hardly have $300 limit. So they say, okay, you know what, just go ahead and close it before we go for our shopping. Well, that's the mistake. The oldest credit is the best one. It doesn't matter how much credit you have, how much credit limit you have on that. Do not close anything. Okay, and same way, do not open anything either. I mean, you don't want to put more inquiries on your credit before you go there, because they ask these questions very seriously. And if you have more debt, so you get qualified for lesser amount. So make the mortgage your priority. Just get the mortgage first, and after that, buy your car, buy your credit card. They have very less restrictions. The mortgage loan has a maximum restrictions, and today the mortgage world is totally different. All the full documentation loan, we don't have those stated income funding loans like we used to have before 2010. So, and the capacity is your income. That you want to make sure that you really can afford the house, and you have a stable job for at least 2 years, and you have some good cash reserves. Number of borrowers. If you have two people on the loan, of course you qualify for more because the income is more. And products, we're not going to talk about the products here and purpose of the loan. We're just talking about simply how much you qualify for to purchase a house. So last thing is the collateral. That's your property you're purchasing, how much money you're putting down, how much equity or your stake or your skin in the game is. The better equity you have, better down payment you have, better loan you'll get, better interest rate you get, and you don't have to purchase a PMI, which is insuring lender against the loss, and you're paying for it. For that, you have to pay at least 20% down, so you're saving on that. Now this is the number. Right now, 43%. So that's how the underwriter calculates. That's how the underwriter approves basically your loan. They qualify your income on base of this number. Now, what is this number, and how do you calculate by yourself? Well, that's why I'm doing this tutorial. Okay, so what is this DTI means? It is your all obligations, including whatever is on your reporting on your credit, plus your new monthly payment. it shouldn't be more than 43% of your total income. So it has to be 43% or less, not 43.01. So you count for at least 42% and give 1% accretion. All loan officers do that. So let's say, example, if you make $10,000 gross, okay, and you already have, according to your credit report, you have a car loan for $450 per month, and you have some credit cards, like 4 or 5 credit cards, and total adds up to, $285 per month, and you have an old student loan sitting there, which you're still making the payments on, $360 per month. So let's calculate all together, and all adds up to $1,095. Okay, and now you're going for a new mortgage. Okay, so let's say you're looking to buy a house worth $500,000, and you're putting $100,000 down, and your loan amount is $400,000. You're getting interest rate at 4.125, and if you calculate the payment, well, you can calculate the payment on the web. So you can go to bankrate.com and calculate your monthly payment there, approximate, this is the rate right now going on, and you will see what's the ongoing rates there too. I'm not referring, or I'm not selling anything here, so I'm just doing this tutorial. So let's now, with all this information, you have your monthly payment, principal and interest, 1909.66. So this is your principal and interest, and on top of this, you have a property taxes. It generally goes 1.25% of the purchase price. So 500,000 divided by 1.25, so like 6,250 a year. Now you divide it by 12 to make it monthly payment, so $520.83 per month. Now you have a homeowner's insurance for $1,500 a year, so divide that into a monthly payment, so $125. You add all that together, so you'll get the PITI, principal, interest, taxes, and insurance. That's what you call it. Now your total monthly payment, including everything, is $2,555.49. You have this number now. Okay, so you have your current expenses according to your credit report, and now you have your new mortgage payment. Add them up, and total comes to $3650. So it's this number, $3650. 0.49. So now you divide this by your gross income, and you get this number, 36.5%. So this is your DTI. So this 36.5% is your DTI, which is less than 43%. Of course, you're good to go. You basically, maybe add another 25, 30,000 if you want to purchase a little bigger amount of the house. But this is just for tutorial purposes. Now let's see. Now your income is qualified. Now what? It's not over yet. They check your credit, which is good. They check your income, they accept it. Now collateral is not accepted yet. You need to get an appraisal done. Well, they do the appraisal. Generally, it comes okay, and it gives you the real value of the property. So sometimes seller wants to sell something, they always want to sell over the price. So appraisal is the one which tells them this is the real value of the market, and then they don't have any choice to reduce the price. Sometimes it depends upon the market. It is always give and take. So once you have these three things, we're good. And this is not done here. Okay, you need to know some more things, which is very important to close a file on time. Okay, so you need to be fully prepared. We need to have a complete loan file. Loan officer is not a magician, okay, and they're not the one who create trouble. They're actually out there to do a professional job, and they really need your help to provide them all what they need. So if you know everything and you're providing everything up front, your file will hardly have any conditions later. So this is what you look for. Your income documents need to have your 2-year job history. When they give you application, fill it out completely, or they fill it out for you. So you need to provide them 2 years of your W-2s and 1 month of your pay stubs. This is it. This is the income documentation. I'm just talking about the regular income people, W-2s, and if you're a self-employed, that's a whole different ballgame. And in the assets, they look for your 2 months of your assets, your bank statements, any 401k or insurance, cash value, or in stocks or bonds or whatever money, wherever you have the money sitting, just provide them. But do not move your money around, okay? So you don't want to consolidate all your money because you're buying a house into one account. Let it sit wherever it is, okay? So that's another questions all the time. So underwriter always delay the loan. They need all that questions answered. It's not the underwriter, it is agencies, Fannie Mae and Freddie Mac. They have those guidelines. So a lot of people get really pissed off when the bank asks them another month statement, empty page. They didn't provide even the blank page. Page number 6 has no information. They still want to see that. So give them all. Don't hide anything. Give them all. All right. And besides this, other documents, like when they run your credit, they're always 120 days of inquiries you need to answer. You need to provide a letter of explanation. Even just provide them. Even you ask the loan officer, take it from me, because this is what they need. They cannot fund the loan without it. So why not just provide them everything up front? And most important is this guy, okay? Explanation of the large deposit. If you have, let's say you're making $10,000 a month, and buddy of yours gave you $2,000 last month, which he loaned from you 2 years ago, and now you put the money in. Underwriter want to know where this money came from, and you need to answer it. There's no way out. You really need to answer that question and provide them the paper trail. The worst case, they'll not count that $2,000 money as your assets, but some people, they get the money from the relatives and to buy the house. Then they need to provide all that paper trail. Cash doesn't have any footprints, so you need to provide the checks and write them the gift letters and blah blah blah. So many things. Don't move the money around. Keep the money for at least 3 months there. So in the last 2 months bank statement, you don't have any large deposit. This is the key. Now the last thing is addresses on the credit report. If you have some addresses showing, well, you're living in California, and then you have some address showing Texas, you need to explain what is that. And that's about it. This is the complete file. I mean, if you have that, well, you're good to go. So I guess the basic information is this. I mean, if you just comment below, and if you have any question, I'll probably answer that. And the next tutorial, I'll probably do it for the self-employed people who doesn't have a W-2, who do their own taxes and all, business people, taxi or truck drivers and all those people. I'm going to do that tutorial for them. That's very different way of calculating the income, and you really need to know that. Thanks for watching.